heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from San Francisco, this is Bloomberg Technology. Coming up, a global equity rout intensifies, with big tech at the forefront of the sell-off. From Nvidia and TSMC to Robinhood and Microsoft, we hone in on the names being hit hardest amid the carnage. And we'll have full coverage on Apple as Berkshire Hathaway slashes its stake in the tech giant. But first, this is the picture in financial markets. It is an ugly day, but we're off session lows at the index level. It started in Asia. It went to the European session now in the United States. But looking at the S&P 500, even a 3% decline puts us on track for its biggest drop since late September. Chip stocks particularly feeling the anxiety, names like Nvidia, but also TSMC's US ADRs. You saw the yield on the US 2-year Treasury fall below that of the 10-year. Disinversion happened for the first time since July of 2022. The crypto markets are also interesting. Show me Bitcoin and look at the severity of declines. Remember that in the crypto space, we're in an asset class that is trading 24/7. If we can please bring that up, because I want to move things forward. There's also particular anxiety, right, in those single names. You look at Bitcoin down 8.8% in a session, 24/7 hour trading. Apple and Nvidia also off session lows, but in particular, names that leading declines from a point perspective or a percentage change drag at the index level. Let's break it all down. We've got Bloomberg cross-asset reporter Isabel Lee and also our international economics and policy correspondent Michael McKee. Isabel, I start with you. I think this started with economic data on Friday. Then you had news flow through the weekend, and now here we are through an Asia, European, and US session where things don't look very good.
Exactly. It started on Friday. We had weak jobs data, but it wasn't really horrible. So we saw a stock market under pressure. But over the weekend, I was checking my phone because I was trying to figure out what is going wrong. And today we have New York to London to Tokyo. Equities are really getting pummeled. S&P 500 is on track for its worst rout since 2022, with 95% of the stocks there in the red. And I read a note this morning that's saying, instead of asking what's going wrong, it's better to ask what didn't. We have a slew of reasons for that. We have, for instance, a rate hike from Japan, a perceived failure by the Fed to cut rates. We have unemployment, U.S. employment figures. We have Warren Buffett selling Apple shares, and we had a Bloomberg story telling traders, okay, maybe it's really not some cause for panic, but of course we have some traders panicking. And last but not the least is the unwinding in the highly popular trade, which is popular yen called carry trade. We're also seeing pressure in that. So that's a trade where you borrow yen to invest in their high-flying currencies. But really, it's just really a slew of reasons, and I don't know where to start.
Mike McKee, our policy and economics correspondent, the Fed, or at least the market's expectations for the Fed, are a big part of this story. The swaps market at one point pricing in a 60% chance of an emergency rate cut this week. Explain that to me.
I can't really explain it to you except for panic. It was in Asian markets where the volume is lower and people don't understand the Fed perhaps as well. It's really come back now. At the moment, the 1 week swaps are pricing in a 5 basis point move, not even a real rate cut. So at this point, you can't really say that people think the Fed is going to be getting involved. There's more of a wish being the father to the man situation here in the market's always looking to the Fed when something goes wrong. But there's some right with what's happened today from an economic standpoint, in the sense that the ISM services number was good. And with yields falling, we're seeing mortgage rates falling. We're also seeing gasoline prices falling, and all those things could be stimulative to the economy. So the Fed's going to sit back and say, you're losing money in your equity trade because maybe you did the wrong trade, but it's not something we can fix.
Isabel, you sort of masterfully gave this global picture of what happened in equities markets, tying in the economic data. One of the questions I've been getting this morning on social media has been about Bitcoin. Loads of people saying, hold on, you kept telling us that Bitcoin would behave like a haven asset in an environment like this. Bitcoin seems very much tied to the Fed narrative and economic data as well.
But that's the thing. Bitcoin hasn't been really a haven. In fact, it's been more of a barometer of risk sentiment. And now we see Bitcoin and Ether and all the other altcoins really edging lower. And for me, what's interesting is the Bitcoin ETFs and the Ether ETFs, because we've never really seen this economic climate with this product. I mean, a lot of people are comparing it to the great financial crisis or other eras, but then we didn't have Bitcoin ETFs then, so we're really going to keep track of the flows. I have a story from our cross-asset team about how billions were still poured into tech ETFs, and of course now we see that they're under some pain. So it's also going to be interesting to see how Bitcoin ETFs and Ether ETFs trade in this really unfortunate or fortunate, depending on who you ask, phenomenon.
Mike, we always say on this program, Bloomberg Technology, that higher rates discount the present values of future cash flows. So in other words, technology investors track what the Fed will or won't do. I was listening to Bloomberg Surveillance earlier, and they're talking about this distinction between the Fed's lesser focus on restrictive policy and a future move to accommodative policy. What happens next? I know that's really impossible for you to answer, but go ahead.
Yeah, that is a sort of impossible setup there, because the Fed is going to want to wait as long as possible. They don't want to do anything emergency. They don't want to react to stock market ups and downs. As long as you can trade, they don't care which way the trade goes. But the data have to show the Fed that there is a significant shift in the economic outlook before they would consider doing something like a 50 basis point cut or moving much more closer to accommodative. They're still on track for 25 in September because they think they need to normalize. They need to get back to a closer to neutral rate. And I don't think that's going to change, at least in their minds, unless we see some data start to come in really badly. And the first data we had out today, the ISM services numbers, come in better than expected across the board. So their caution is going to be dependent on the data, and the data at this point are not telling them they need to do anything.
Bloomberg's Mike McKee and Isabel Lee, the best of Bloomberg Television out in New York. Thank you so much. Let's get more on the markets and bring in Angelo Corcaffa, senior strategist at Edward Jones. And I'm always one for a data point. I'm thinking specifically about the Mag 7. And we have this index or gauge of the Mag 7 at one point in the session, its biggest drop on record. Take everything that our team have just said and apply it to what's happening with the biggest technology names.
Sure, hello. Clearly, volatility didn't take the summer off. We saw the markets were led by the Magnificent Seven, and on the way lower, it's been the Magnificent Seven that have been really the weak spot. I think the issue has been that of expectations. These companies continue to deliver outsized earnings growth, but the bar was very high heading into this quarter. And as a result, we did see some disappointments. These were the names that have been trading at the highest PE ratios. So as we're talking about the yen carry trade, many hedge funds borrowing in yen to invest in other assets. And now with the yen appreciation, they're selling some of those assets. And no doubt, some of these are the Magnificent Seven stocks. So we have a combination of high bar. We have earnings broadening to other sectors. For example, this earnings season, we have seen the biggest earnings surprises coming from defensive sectors and also some of the cyclical ones, and not the growth sectors that we have been used to over the last couple of earnings seasons. But at the same time, the fundamentals have not changed.
Exactly. So let me jump in. The fundamentals have not changed, is what you just said. We made a big deal of the gain in the S&P 500 in the first half of this year, 14% or so, largely coming from the Magnificent Seven. And in years where the S&P 500 has gained double digits in 1H, it usually goes on to perform in 2H. How much of a departure is this session from that historic trend?
No doubt this is an abrupt and uncomfortable pullback. And I think there's two things going on. One is the technical picture, which, if it is an overreaction that potentially move lower, presents an opportunity for the remainder of the year. And then the second part we need to answer as investors is there something fundamentally broken? Meaning, are we heading towards a recession? Because a lot of that narrative has been around the growth scare. And I think for our clients' perspective, we need to first answer the latter. The U.S. economy still continues to grow. Let's call it trend or maybe slightly below trend. Looking at the GDP Now estimate for Q3 is still slightly north of 2%. We just got the ISM services PMI that was well into expansion territory, and the employment component, very importantly, provided some reason for optimism given the Friday jobs report that we got. So we do not think that the U.S. economy in a week's time is going to fall off bad. We have seen still rising earnings, corporate profits, consumers, and corporate balance sheets remain healthy. So I think it fits into the narrative of broadening in market leadership away necessarily from the overall and potentially overextended tech. So we are still positive for the remainder of the year, but we don't think that the Magnificent Seven are going to be once again the ones that everybody gravitates towards.
Angelo, chief of among what you've just outlined is Nvidia. We are way off session lows. Nvidia is down 6%, but one point in the session was down 15%, which for a company that size is a big drop. There was a report from The Information that said Blackwell, the next generation AI accelerator, would face delays due to a design issue. Over the weekend, Nvidia got back to us and said that actually Hopper demand is strong, Blackwell sampling has started, they don't comment on rumors, etc. You just said that we'll move away from sort of the concentration of leadership, but we have to wait until the 28th of this month to get Nvidia earnings. That's quite a long period of time in which the markets could have some anxiety for what has been a leader in the direction of travel. What do you make of that?
Yeah, the Nvidia is the last of the Magnificent Seven to report earnings, and no doubt a stock that everybody, the whole world is watching. The theme so far with everybody's excited about the artificial intelligence, but there has been some skepticism over the last couple of weeks. And investors are getting increasingly impatient to see the heavy spending of AI translate into return on profits. But what we have been hearing from the remainder Magnificent Six of the Seven, that they have been spending, so that should continue to be a tailwind for Nvidia. And I think what we are coping with here is, again, the high bar of expectations. When you have a stock that's been up so much over the last couple of years and so far this year, even with the recent pullback, naturally that creates tension points whenever news like we have been getting over the last couple of weeks emerge. But at the same time, again, we still continue to be positive around artificial intelligence, not only for this year, but for the next 5 to 10 years. And I think that is important for investors to remember.
Angelo Corcafa, Senior Strategist at Edward Jones. Thank you. We said that this all started in the Asian session. The TAIEX saw its worst day in 57 years after TSMC shares plunged 9.8%, a record daily decline for the AI chip maker. TSMC accounts for more than 30% of the TAIEX, which closed down 8.4%, its worst sell-off since 1967. Indices in Japan and South Korea also fell significantly in their Monday sessions. Coming up here on Bloomberg Technology, we're going to hone in on Apple as shares plunge and Berkshire slashes its stake in the iPhone maker. The stock down 3.3%, again off session lows, but a significant decline. This is Bloomberg Technology.
I believe it's a buying opportunity for the high quality, large cap names that we like to buy in these types of periods.
Dan Ives of Wedbush earlier saying it's an opportunity to buy the dip in big tech. I know he's not alone in calling for that this morning. Let's also take a look at shares of Apple. We are way off session lows, but at one point in the session, we're down more than 10%, which was a worrying way to start the US session on a Monday. Let's bring in Bloomberg's Mark Gurman. One of the catalysts or news flow items over the weekend was Berkshire Hathaway slashing its stake in Apple, largely to generate cash. But there's this story on the Bloomberg about how Apple investors have been urged to keep calm in spite of what happened. Elsewhere, we're just concerned about growth. The Apple side of this story, please.
When you have declines of this magnitude, you mentioned the 10% decline in the early hours of trading. Now it's down to about a 3% decline. These are more macro-related issues when you have those big swings and that volatility, right? There's nothing that Apple necessarily did. There's no news item related to Apple's actions, a product, its earnings from last week. A lot of this has to do with macro concerns, the situation currently going on in the Middle East, the uncertainty surrounding the election, people wanting to hold on to their cash. But of course, as you mentioned, the Warren Buffett Berkshire Hathaway news from over the weekend. Compared to the beginning of 2024, Buffett's stake in Apple is now half of what it was. He still has about an $84.2 billion stake, so a huge stake remaining in Apple. But when you get those headlines about Warren Buffett, right, selling that much Apple over the course of the last 6 to 8 months, that could be concerning. Combined with some of the other concerns, Greater China, artificial intelligence, growth, the performance of the iPhone moving forward, their guidance, certainly all of that combined in addition to the macro factors.
Bloomberg News reflected going into Apple's earnings that some of the run-up in the stock over recent weeks and months had been really about faith that Apple Intelligence would deliver. You've written over the weekend after earnings that actually with Apple Intelligence there's a long way to go. What were your arguments?
Yeah, Apple Intelligence obviously is going to be a big initiative for Apple moving forward. They're marketing this heavily on the earnings call. I didn't get an official count, but I'm sure Tim Cook mentioned it at least 15, 20 times. Nearly every analyst asked about it. That has been a big catalyst to stock growth. But I don't think the initial feature set or even the feature set in totality is something that's going to drive iPhone upgrades for this cycle. I think it's something that's probably going to drive upgrades in future cycles. Now, I want to be clear. I don't think there's a connection between realizations about the performance of artificial intelligence and this Apple stock decline. If you look at the rest of the market, they're in decline as well. So I think it's largely about more macro factors than anything very specific in particular.
Bloomberg's Mark Gurman on all things Apple. Thank you. Time for Talking Tech, and first up, TikTok is being sued by the US government for allegedly collecting data on children. In a suit filed on Friday, the Justice Department claims the app has allowed millions of kids under the age of 13 to create accounts without their parents' knowledge or consent in violation of an online privacy act. TikTok previously reached a settlement in 2019 with the FTC on concerns related to child privacy. Plus, online trading platforms from Robinhood to Fidelity and Charles Schwab have been suffering outages amid a surge in volume during this market sell-off. More than 14,000 users reported an outage at Schwab at 9:50 a.m. in New York. That's according to the website Down Detector. The firm did not immediately respond to requests for comment, but a company account posted on the social site X that some clients may have difficulty logging to Schwab platforms. And shares of Nvidia falling today amid the tech sell-off. According to reports, the company's upcoming AI chips will be delayed by 3 months or more due to a design flaw. An Nvidia spokesperson responded to Bloomberg over the weekend saying, as we stated before, Hopper demand is very strong. Broad Blackwell sampling has started and production's on track to ramp in 2H. Beyond that, we don't comment on rumors. All right, more on AI. Groq has raised $640 million in a Series D funding round, bringing their valuation to $2.8 billion. The startup focuses on building fast AI inference technology to supply increasing demand. Delighted to bring in Jonathan Ross, founder and CEO of Groq, for more. Just last week, we were speaking to Lisa Su, the AMD CEO, about the move from training to inference. It's a sizable chunk of change you managed to raise. I guess the best starting place, what will you use the cash for?
So the first thing is that we're going to build out about 108,000 of our LPU chips, or language processing units. To put that in perspective, you mentioned Hopper, the Nvidia GPU. Last year, they shipped about 500,000. So this would be about 20% of what they shipped last year. Secondly, we intend to hire significantly. We're building out a lot of features. We actually offer a token as a service business where people can just use our hardware without having to buy it. And then we are looking at some acquisitions going forward as well.
Strategically, when did Groq sort of say, okay, inference needs to be our focus, and how is it helping you get ahead? There's lots been discussed on this program about the many startups and companies working on training large language models from many hundreds of billions of parameters to smaller models. You have a more narrow focus, Jonathan.
Yeah, so Groq from the beginning is focused on inference. And the reason is training at this point is a well-solved problem, and we always knew that it would be. My background, I actually started the Google TPU chip, and we actually started with inference there because we're actually able to train the models. We just couldn't afford to put them in production. Typically, whatever you spend on training, you will continue to spend going forward, but you're going to spend 10 to 20 times that much putting it into production. You spend money to make the models, you make your money with inference. It's also a scale game. And so we've been focused on this since day one.
There's also sort of a relationship and talent conversation to be had. Jan LeCun over at Meta is going to be your new technical advisor, which was in the news as well. Why is that important to you?
So Jan LeCun is legendary in this industry. He won the Turing Award for being one of the 3 people who invented the algorithms that make modern AI work. And of course, Jan LeCun is very centrally positioned in terms of AI. He's also pushing very heavily for open source models or open weights models. And this is something that's important for the industry. Groq actually wouldn't exist today if it wasn't for open source models. We'd actually built the world's best chips, but if we didn't also have the software to run on it, we wouldn't be able to demonstrate that. And so the Llama models from Meta effectively are the Linux of the generative age, and it's enabling people to get into the AI business without having to train the models themselves.
Jonathan Ross, founder and CEO of Groq. Welcome back to Bloomberg Technology. Ed Ludlow in San Francisco. I go straight to the Nasdaq 100. So we're off session lows, down 2.3% or so in this session. But we remind ourselves something that we talked about on Friday. The Nasdaq 100 closed Friday with 4 straight weeks of declines. So what's happening right now in the moment, there is anxiety in global financial markets, but it's kind of been happening over a longer period of time in terms of the downward pressure on technology stocks in particular. In terms of single names and specific asset classes, Nvidia is under pressure but off session lows. Apple actually is now down 4% and its declines have started to accelerate, but nowhere near the near 11% drop at the open. And then Bitcoin, well, $54,000 per token, trading 24/7, but we're down 8% in the current US session. There's a lot to discuss. Delighted to bring in my friend, Bloomberg Sonali Basak. I mean, you had 2 hours on open interest, right? And I think that you probably discuss all manner of things, the basics being a move into the bond markets, the safety of them, Bitcoin's not behaving like a haven asset, and equity investors are either very worried or completely sanguine. Reflect on some of the conversations that you've had.
A few things, Ed. To the point that you're making here, you're looking at the 3rd day of declines in the S&P 500, and in the Nasdaq 100, it is the 3rd day of declines of more than 2%. Friday, you saw the Nasdaq 100 really flirt with that correction territory. Then over the weekend into today, you saw the Asian trade just really sell through the ground here. You saw really historic moves there in Japanese equities, for example, and what you saw was an unwinding of a global carry trade. This is when investors are borrowing under a cheap currency and really plowing those assets now into higher yielding U.S. assets, particularly stocks in this instance, which is why you're seeing that unwind now. The major question is how far does that unwind really go? On top of that, there's very few places to hide. To your point, Bitcoin today now flirting with about 55,000, had fallen below 50,000. You saw gold dropping this morning, oil dropping as well. You saw a lot of risk-off attitudes across the board and in the bond market as well until you saw that ISM data hit and give a little bit of a sigh of relief. You are now watching a bond market, the 2-year yield essentially about flat on the day. So that severe bid in the bond market starting to take its foot off of the pedal here, and stocks taking a little bit of a breather along with it, still down on the day, but not as severely as we started the day lower. Those small cap equities also taking a major hit today as well. Remember, recently, a lot of traders plowing into that Russell 2000 rotation, really feeling the pain. So underneath the surface, a lot of pain. I will also say takes a couple days to see those margin calls also start to come through. Big question here about whether there is more pain once you see those calls start to come through the market.
Starting Monday with a discussion about margin calls. Happy Monday to you, Bloomberg Sonali Vasek. Thank you. Let's get the investor's perspective. Nancy Tengler of Laffer Tengler Investments here to talk markets. And with respect, you've been in and around the markets a lot longer than I. But I just want to go back to the point I made in my market check that the Nasdaq 100 had 4 straight weeks of declines. Bitcoin traded lower through the weekend over multiple days. When you wake up to a day like today, is it anxiety or is it, well, we should have seen this coming a little bit?
Well, yes. Thanks for having me, Ed. I think we kind of did see it coming as earnings started. The penalty that Alphabet received for CapEx spending and just somewhat weaker margins in the next quarter seemed outsized to me. And that's often what happens when valuations get a little bit lofty. And then every bit of news, every bit of headline news drives the market because the algos are reading the headlines, the hedge funds are trading off of the headlines. And so you get these big outsized moves. If you put it in the perspective of the 40 plus years I've been doing it, historically, this has been a time when you've wanted to step back, not jump in too quickly, but build a list of names that you want to own. And then as the markets sort of settle in, the VIX comes down a little bit, then I think this is once again an opportunity. The last thing I'll say about this, Ed, is that the one economic number that has been little discussed and gone unnoticed was the improvement in productivity in Q2. Came in much hotter than expected, up 2.3%. The previous quarter was revised up also. And I think productivity is going to be the key, the magic bullet, whatever you want to call it, for continued economic growth in a lower inflationary environment.
Take what you just said about productivity then, and I posed the question of what should the market do with that? Mike McKee was on the show earlier trying his best to explain why the swaps market would price a 60% chance of the Fed doing an emergency rate cut this week. And that seems more tied to the equities market rather than warding off a recession or not. I'm just trying to tie macro and monetary policy with the market's behavior right now.
Well, yeah, and if you had been, well, you certainly know about the bond vigilantes, but that's what this feels like to me. It's the market having a temper tantrum because they think the Fed has waited too long. They probably have waited too long. They've been behind the curve, so to speak, all the way through this process. And this notion of being data dependent in a world where you need to be looking forward, and where their 400 plus PhD economists are forecasting models, they have made, in my estimation, an enormous policy error. But that said, stocks ultimately should trade off of earnings. I think we get a cut. I don't think we get an emergency cut as the market would like. And I actually think that would be bad because when you look at the economic numbers, the economy's just fine. I mean, the jobs numbers are revised dramatically every month. And so I think you have to step away from that and say, was that an aberration on Friday? We know the job market is softening, but is it collapsing? I don't think so. And so I think this is an opportunity for long-term investors once the dust settles, because there'll probably be a few more runs to the downside. And then I think you step in and you add high quality names.
Nancy, Nvidia reports its earnings after market on August 28th. How uncomfortable are the next 3 weeks going to be?
I think they're going to be uncomfortable, Ed. I think that, and remember, we've seen this every year, 2022, 2023. We were told in the summer swoon that the tech trade was over. But remember, the CapEx spend that Alphabet and Amazon and Microsoft have been punished for is someone else's revenues. And so I think Nvidia is likely to surprise to the upside. We heard from Lisa Su. I heard you mention her earlier. That's a name we've been adding. I think it's going to be a catalyst for some outperformance and stabilization.
If you're able to, please can we look ahead to the second half of the year? We talked a lot about how in years where the S&P 500 registers a double-digit percentage gain in 1H, it often performs well in the second half of the year. I think the Nasdaq 100 has similar precedents or history. Is that your expectation of what's to come?
Yeah, well, Ed, based on what I've heard from the companies from an earnings standpoint, you're hearing, and most of us are hearing, that it's not been a good reporting season so far, but there have been very meaningful bright spots, companies raising guidance, companies expanding margins. So I think that you have to, again, as always, you've got to let the markets work through this stuff. But the second half, based on what we've seen at the company level, should be better and up in our view. And seasonality is in our favorites in election year. That doesn't always work, but we do think we'll be certainly be higher by the end of the year and even into 2025. If the tech trade is over, people need to be much more worried about the rest of the market because technology is embedded in every aspect of many companies' day to day and their future earnings and margin growth.
That is the argument that Bloomberg Intelligence's Gina Martin-Adams literally wrote this morning. We're going to talk about it with her later in the show. Nancy Tengler, CEO of Laffer Tengler Investments, thank you very much. Now, coming up on the program, we're going to be joined by Matt Withheiler from Wellington Private Investments for his take on private markets, late-stage investing, but there are always parallels with what's going on around the world, even with public markets and public equities. I'm really looking forward to this one. That's next. This is Bloomberg Technology. Right back to financial markets and mega cap tech. We're going to look at the Bloomberg Index, which tracks the Magnificent Seven. These are the biggest mega cap technology companies. At one point in the session, the biggest drop on record. We paired that. That's kind of the story of the session so far, down 3.5% on the Mag 7. We've outlined all the concerns so far. Part of it is the worry about growth, and we can wait until Nvidia's earnings on August 28th to carry on that conversation about growth, particularly in the context of investment in AI infrastructure. But there are lots of parallels between public markets and also private markets as well. Let's talk about the investment landscape when it comes to late-stage private tech companies, also IPO tech activity, I suppose, with Matt Withheiler, consumer and technology lead for Wellington Private Investments, also joined by my friend Hema Palmer of Bloomberg News. Good morning to you, Matt. When you wake up to a day like today, you're largely focused on growth stage venture investments. There are different factors you're tracking, but how do you react? How does it make you approach your day-to-day work?
The short answer is that on a day-to-day basis, the fluctuations and volatility in the public market don't really impact the late-stage private market where we focus. There's obviously implications if this persists when it comes to exit opportunity with respect to IPOs and valuation concerns, but the day-to-day volatility doesn't really impact the late-stage private market unless it sustains.
And when you look at AI, some of a good portion of the pain we're seeing right now is in the AI stock space. Does that inform how you look at AI investing when it comes to late-stage growth investing in artificial intelligence?
Again, I wouldn't characterize the public markets as having a huge implication in the short term on the late-stage private market, but I would say, with respect to AI, you kind of have to think about and address two questions. Question number one is AI a transformational shift in technology platforms? You kind of have to answer that. And then the second question I think you have to answer is kind of where are you with respect to AI-based transformation or AI-led transformation? And I think those are the two questions you have to answer as a late-stage private investor to think about where you should be deploying, if at all, and what the landscape looks like, not over the next month or two or quarter, but over the next multi-decade.
So as you look to invest the $7.5 billion that you oversee in private markets, where is the biggest opportunity for you right now?
I mean, I think I couldn't be on this show and be talking to both of you without talking about AI and AI-led disruption. When you think about fundamental transformational shifts in technology, we believe that AI is a disruptive technology that will be a generational shift in how technology is ultimately deployed and adopted by enterprises. But then to the second question around how are we or how far along are we in that transformation, I think we're very early. And so when we think about opportunity set and we think about AI, we're long-term very bullish on the opportunity. You think shorter term and think about where we are within the inning, the game of AI. And given how early we are, I think one of the questions that we end up asking ourselves with respect to AI is, will today's winners be the winners that persist over a long time? And I think when you look historically at tech-led disruption when it comes to generational shifts, like the internet, like cloud, like mobile, the early winners oftentimes are not the long-term winners who end up creating multi-billion-dollar public companies.
Matt, you said that near-term or daily volatility doesn't really impact thinking in the here and now, but it does impact sentiment towards markets. And therefore, we need to ask about IPOs. Where do you see the remainder of this year with some of the late-stage companies that are waiting in the wings to go public?
I mean, I think, as you've talked about through the show, Ed, the landscape has changed pretty dramatically over the past 2 trading days. And absent those 2 trading days, I would have said that the IPO market is probably on the rebound, likely to start accelerating through the back half of this year and early next year. And given the noise, the volatility we're seeing today, will it cause the company that maybe is on the margin thinking, should I go public or not, to reassess and maybe delay until early next year? Most likely. That being said, if you go back, not over the last 5 or 10 years of IPO data, but if you look back at the last 50 years of IPO activity levels, generally the IPO window, in other words, the amount of IPOs coming out, tends to be dramatically below the norm or the mean for 1 to 3 years. And if you think about where we sit today, we're kind of in the middle of year 3, the first quarter of Q3 of IPO activity being meaningfully down compared to historic periods. And so based on that, I would guess that we maybe have anywhere between 0 and 12 more months before we do see a rebound in IPO activity. Okay. And we're starting to see a little bit of it today. If you look back, last year we had 3 tech-led IPOs go public last year. This year, year to date, we've had 5. So already at an accelerated pace. Will we take a pause given what's going on today? Potentially.
Matt Witheiler, Consumer and Technology Lead for Wellington Private Investments and Bloomberg's Hema Palmer. Just very dynamic and timely conversation. Thank you. Back to markets. Let's bring in Gina Martin-Adams of Bloomberg Intelligence. And Gina, I went straight to your bio on the Bloomberg terminal this morning. I'll summarize, but you're basically saying, look at earnings in aggregate on the S&P 500 and stop blaming earnings. Blame something else. Who are you holding responsible for what's happening, Gina?
Yeah, I think that really if we look at the sequence of how the market has melted down over the last couple of weeks, it's been predominantly about tech and kind of a loss of faith in tech. Now, I think it's important to consider where we've been as well. When you look at the broad markets, we wrote a couple of notes last week that I think are pretty telling. The first is we identify 4,344 reasons why tech faced impossible expectations. Those reasons are basis points and valuation multiples. 4,000 basis points above long-term average or 5-year average on the multiple would suggest that expectations for tech companies were extremely high coming into the last week. You had a couple of key headline misses, but for the most part, tech companies actually satisfied second quarter expectations. It was about their guidance, and this is the trigger that the market really played on. Then you piled on top of that some key macro indicators in the ISM and the employment numbers that weren't as strong as many had hoped for, and you have a full meltdown on your hands. But this is really at the foot of tech, and investors' expectations that tech were just far too high coming into this earnings season. We're now normalizing those expectations, and that's creating a bit of panic in the market.
Investors' expectations are interesting. I mean, I think about Microsoft, for example, as just one case study where they missed estimates on cloud growth by a percentage point, but still registered 29% top-line growth in the most critical unit. Is it just sort of idiosyncratic, or is this broad-based anxiety from investors that something will give way on the growth narrative overall?
Yeah, I think it's a great question. It's really difficult to tell so far, but what I can say is over the last week, what we have seen is just severe punishment of any tiny nuance, as you correctly highlight with Microsoft. Very, very strong aggregate growth, but a tiny nuanced miss was enough to really create a lot of uncertainty around that story. You see a lot of the same emerged with Amazon, similar sort of reactions even to Alphabet. So across the tech and tech adjacent space, we saw very similar reaction functions emerge, and that is, I think investors just got ahead of their skis. They were expecting tech not only to beat, but to raise expectations, beat almost perfectly. That was embedded in valuations, and now we're normalizing that. Now, this is tough because at this point in time, it was impossible for tech to keep creating stronger and stronger momentum in earnings. We're now getting to the point where second quarter, third quarter earnings of this year are facing incredibly tough comps. So tech earnings, even in the best of circumstances, are going to show decelerating growth rates over the second half of this year for the first time in quite some time. They were the only story of accelerating growth in the market in 2023 and early 2024. Now they're showing some decelerating in growth, while the rest of the S&P 500 is actually showing a growth acceleration, but we're kind of ignoring that because tech has been so key to the market performance so far this year.
Well, you can also sort of pick and choose your data point, right? So in the first half of this year, the S&P 500 rose 14%, largely attributable to the Mag 7.
Right.
But the other data point is that in years where the S&P 500 has registered double-digit gain in 1H, it usually does quite well in the full year or the second half of the year. So which one do you put emphasis on? The index or the names that drove the gains initially?
I think it's a combination of both. I hate to wiggle around your question with a waffly answer, but I do think it is a combination of both, because if tech continues to sell off, if we still have weakness in tech, it's almost impossible for the index to overcome that. But the tech sell-off is really about right-sizing expectations, and the rest of the index is producing growth. This is one major nuance when we compare 2024 to 2023 that I think is important to acknowledge. When tech sold off in the third quarter of 2023, remember we had a 10% correction last time this year as well. But when tech sold off in that instance, it was basically a one-for-one. As tech sold off, the S&P 500 sold off just as much. This time, the S&P 500 is down just more than half, or just about half as much as tech.
Okay.
Because you have some natural stabilizers that have emerged in 2024 with that earnings recovery that is emerging in the rest of the index. Does that sustain itself? Can it gather a little bit of momentum and a little bit of attention is a really key question we should be asking right now.
Yes. Gina Martin Adams of Bloomberg Intelligence, thank you so much this Monday. That does it for this edition of Bloomberg Technology. Don't forget to recap all the conversations we've had today on the podcast. They were dynamic and there is a lot going on. You know where to find it, on the terminal, the Bloomberg platforms, as well as on Apple, Spotify, and iHeart. From San Francisco, this is Bloomberg Technology.